This is Trader's Workshop with Adam H. Grimes. Hello, welcome to episode 11 of Trader's Workshop. This episode is Types of Technical Setups. I'm your host, Adam Grimes. You can find more of my work at my blog, adamhgrimes.com, and you also should follow me on Twitter at adamhgrimes. So, who is this episode for? Basically, I think it's for everybody. If you're a developing trader, you haven't placed that first trade, then I'm going to help you clarify your thinking from the very beginning. If you're a net profitable trader and you have your system, you have your style, I'm still going to try to get you to think about things in terms of some different categories. This may help you both clarify what you're doing and maybe think about some things that you might do a little bit differently or things that you might add, or conversely, even things that you want to very clearly put outside the scope of how you trade. This is a topic that I did not really understand until I'd been trading for probably 12 years. When I started trading, I just had setups, and my thinking was very much focused on finding a pattern. And sometimes they were market patterns, sometimes they were indicator patterns, but it was the idea of having a pattern that would show me that something was likely to happen in the market. And as my trading evolved and developed, I had lots of different flavors and variations of these. And some of these were pretty, I guess I should say complex, but I think of them now as kind of convoluted. I had a lot of different indicators with specific settings. And I spent a lot of time looking at different nuances of how the indicators work together or what they were triggering. And then as my trading evolved and became a little bit more simple, I realized that a lot of these things were kind of the same thing. And I would even go a step further and say, if things are kind of the same thing, if you are trying to pick off points where the market's gone too far, that's a very typical way to trade, which we'll talk about. So you look for where that rubber band is stretched a little bit too much and is likely to snap back. This is mean reversion trading. It doesn't really matter how you're categorizing or exactly how you are finding that trade, whether you're using a chart pattern, whether you're using Bollinger Bands or RSI or some combination of these things. What you're still trading is that underlying tendency in the market. And this also, as my backtesting became more sophisticated, this is kind of an interesting thing. As the way that I was looking at data became more sophisticated and more powerful. What do I mean by that? My first back tests, and this is an entirely separate topic, but we'll touch on it here, were literally with pencil and paper. I would go through charts on the screen and write down on a piece of paper entries and exits. And of course that evolved over the years as I developed some programming skills, and eventually as I understood more about statistics, I was able to bring different statistical tools to bear. And so I went from maybe looking at, in the course of a good day's work, a few hundred trades on one or two specific markets and time frames, to being able to test tens or hundreds of thousands of patterns over many different markets in a single session. And to look at these, whether, initially, I just wanted to know, did the thing make money? If I did these trades, was I going to end up with more money won than lost and enough to pay for my transaction costs? So really that basic question of, does the thing work, to asking the correct, I now think the correct statistical questions, which is, does this work in the direction I think? Am I able to overcome transaction costs? Of course, that's a given. And how certain can I be that this is not just noise, that I didn't just get lucky on the test? And that's a measure of statistical significance. So as I started to look at data in more sophisticated ways, my trading became simpler. Turn that around in your head for a minute. You would think as you have more sophisticated toys to play with data, that is you're able to code in different programming languages and write different algorithms and maybe even have other people write pieces of algorithms that you use in your own work. You would think the more computing power you bring to bear on the market problem, the more sophisticated your trading would be. And you would also think that a very experienced trader might be doing something that is leaps and bounds in complexity beyond what a beginning trader is doing. I hope I said that right. I feel like I may have misspoken, but you would think that a sophisticated, experienced trader might be doing something much more complex than a beginning trader. In reality, that's often not the case. And the reason that I naturally gravitated in this direction was because I saw what a difference tiny little things could make. If, for instance, let's say you're looking at Forex data, what data source you use will give you a completely different set of trades. If you are, let's say, looking at an intraday system on the S&P, a slight tweak in parameters will give you a completely different set of trades. And on and on and on. Very small changes. Here's another example. Let's say I test a pattern on a basket of stocks. Well, how do you do that? There are roughly, depending what time period, 6, 7, 8,000 listed US stocks. Obviously, most of those weren't very liquid. So if you filter for liquidity, you get down to a few thousand. So do you test the pattern on a few thousand stocks? Well, are you going to trade a few thousand stocks would be the question that I would kick back to you on that. So it's obvious we need to take some kind of sample. But if I pick a large sample of stocks, what do you think a large sample is? Let's say a couple hundred, say 200-300, and I run my test. And then I run the same test again on another set of 200 or 300 stocks. Exact same parameters for the test, exact same time window, so we've got the same market regime. You're going to see possibly very different results. So what I began to realize was that by focusing on the nuance and the details in my setup, I was missing the overall thing we were trying to accomplish in the market. So if I'm overly focused on should I use a 12 or 13 period CCI and should my trigger line be 25 or 30? Now, those questions, we can argue those are very important, and the reason that they might be very important is because they define your discipline. You know, if you're waiting for a specific setup and you've defined the setup, you don't take a trade if you don't have the setup. So the setup for a discretionary trader, a semi-discretionary trader, is kind of it's kind of a gate that opens unless you trade or not trade. And if you're making trades when you don't have a setup, you're not a disciplined trader. So there is value in that specific definition of your trade. But that value, I came to believe, is limited, because what are we trying to accomplish? Are we trying to pick off those overextended spots? Or are we trying to find points where the market's bumped up against a resistance level and then does some kind of breakout? How we define the minutia of the trade, the details of the trade, are probably a lot less important than what we are trying to accomplish in the big picture. And you also can loop that back into your quantitative tests. My quantitative testing then took kind of a curve back towards simplicity too. Still using powerful statistical tools, still using programming techniques, still looking at a lot of data, but now testing relatively simple structures instead of precise definitions. I feel like this could very easily turn into a backtesting episode, so we'll do that next. But thinking about big picture, what are we trying to accomplish? I outlined a structure in my first book. And by the way, if you have not seen that book, I would love for you to take a look at my first book. I've written a couple books, but my first book was really my effort to lay out my understanding of technical trading, how markets work from a technical perspective. And if you look at the reviews on Amazon, and by the way, if you've read the book and liked it, I would certainly appreciate a review on Amazon. I say that for the podcast, but also the books. Nothing helps an author out as much as reviews. even more than you buying the book, probably even more than you telling friends. Though if you really like the work and you can be a good advocate for that. Thank you very much. I certainly appreciate that. But the reality of the way people buy things today is that those reviews are very important. And if you look at the Amazon reviews, it's very interesting. Some people get this and some people don't get it. And a lot of new traders who are used to complexity, they kind of miss what I laid out in this book, which I think is nothing less than a complete approach to technical analysis. So I think you could give somebody who has no trading experience this book. Now you're going to have to do a lot of work, and you're going to have to spend a couple years working through the learning curve, but I think everything you need to know to trade successfully is between those two covers. So the first book is The Art and Science of Technical Analysis, published by Wiley in 2012. Go check it out if you haven't seen it. But in this first book, I laid out a claim that there are really only 4 trades. From a technical perspective, from a technical directional perspective, those 4 trades are trend continuation, trend termination, and then 2 support and resistance trades. Support and resistance holding, and support and resistance failing. So for those of you who know setups, let's put some names to some of these. Trend continuation. This would be a market is trending and you're looking to maybe buy pullbacks in an uptrending market, or you're looking to buy breakouts to new highs in a trending market. Trend termination. Now this is carefully named. This is not trend reversal. And a lot of times we do tend to kind of shortcut this to say, oh, the trend's going in one direction. I'm going to sell the exact high. I'm going to short the exact high so that when it collapses into downtrend, yay, I sold the high. That's one type of trend trade, but it also is possible to identify points where the existing trend just stops. And knowing that can tell you a lot about market structure, and there's certainly ways you could play that with options. But I say trend termination instead of trend reversal to be clear that what we're looking for is the existing trend stopping, ending. It may be a trend reversal, but not necessarily. And then you have these 2 support and resistance trades. Support and resistance holding. A very typical way to trade that would be, say you're in a trading range and you buy when it goes to the bottom of the range and you sell when it goes to the top of the range. Support and resistance breaking, these would be your typical breakout trades. So you have a resistance level, market comes up to it, breaks above the resistance level, and you buy the market. So those are examples of ways to trade these big tendencies. But if you were listening carefully, you heard me say breakouts twice, didn't you? I said in the trend continuation that one of the ways we could trade trend continuation would be to do breakout trades in the direction of the trend. And then I said support and resistance breaking or support and resistance failing is obviously your classic breakout trade. And as I have worked with and taught and coached traders, I've tended to simplify this even more to frame out that there are really only 2 categories of technical trades. And these are that you are looking to trade with the existing trend, or you're looking to trade against the existing trend. Now, this brings up this actually brings up more than a couple questions, brings up a lot of questions. How do we define trend? Well, maybe sometime I'll do a podcast episode on that, and we could talk for 12 hours about how to define trend, because it's not a simple question. Leaving that for now, let's just assume that we understand what a trend is, which for our purposes, let's just say market starts at one price and goes to another price. And I promise you, we will refine that in future episodes. There's also this idea of trend following, right? And there's a lot of discussion about trend following. And I do want to be clear that this is not what we are talking about. I think we need to be careful with this, because when people speak of trend following, what they're talking about, generally speaking, are the techniques similar to like what the turtles used in the 1980s and through the 1990s. And a lot of trend following CTAs have continued to use these programs. we need to be careful with this because if you Google, there are several trend following indexes that show the types of returns these firms have in an aggregate. And you need to be careful because some of these do suffer from some survivorship bias. Maybe they look better than they actually are, but a few things are apparent. First of all, these techniques objectively do not work as well in modern markets as they did in the 1980s. Now, the disciples of this approach, or the people selling books and courses on trend following, would have you believe that this is a cyclical thing. It's a little bit difficult to research because of the way markets have evolved, but it does not appear to me with the data that I have, and this is not something that I've done exhaustive studies on, but if we were to go back to, let's say, the 1940s, which I think is far enough considering how long any of us live, right? If we go back to the 1940s and we look at what would have been hypothetical trend following returns through decades, it does not appear to me that we go through periods of 5 or 10 years where trend following really sucks and then it's really great. This is what people are hoping for, right? That the late 80s, early 90s were a trend following utopia when, I'm going to grossly oversimplify, all you had to do was buy a commodity when it broke to a 20 or 50-day high and get out on some kind of trailing stop. That worked very, very well and for a long time, and reasonably well for a while, and it has not worked at all in recent years. And the question, of course, with any approach is this a cyclical thing? So are we going to have some point in the next 20 years when there's another trend following utopia and all you have to do is just buy breakouts and make a ton of money? Or has something fundamentally changed in the way these markets trade? Is there something that is degrading autocorrelation in returns, that is degrading persistence in trend? And the latter appears to be the case. Or at least we go through long enough periods of really challenging performance with, let's say, a naive, a basic trend following approach, that it probably is not a good approach for an individual trader. Because you can have drawdowns for 2 to 3 years and drawdowns of 50, 60%. It's very hard for the individual trader to stomach that in your trading account. And I would argue you probably shouldn't. You know, 60% drawdown is quite a difficult thing. So we're not talking about trend following. We certainly can talk about these approaches in the future. But what we are talking about is simply identifying this broad concept of a trend where a market moves from one price level to another in a more or less directional way. And markets do not typically move in straight lines. And then we're looking to trade with that direction. And then the other type of trade, if we simplify my 4 trades into 2 trades, one is to trade with the trend, and the other is to trade against that trend. Now, trading against the trend would seem to be a stupid thing. Let's just say it like it is, right? If a market is going from one price level to a higher price level, why in the world would you want to be short that market? Because you're on the wrong side of the trend. Or if a market is, and we certainly can find charts of where things have gone to zero. Markets, literally individual stocks, some commodities have traded essentially at zero. Things do, in fact, go to zero. So if you were to go back in a time machine and know that you had a market that was starting at one price and going down to zero, why would you ever buy that market, right? It would seem to be stupid. Why wouldn't you just want to position with the trend? The reason is because I said markets don't move in straight lines. They tend to move in zigzags, and they tend to move back and forth in emotional extremes. If you have that market going to zero, that's actually a pretty good example. The psychology of that is that it's not going to start at one price and go straight to zero. No, there are going to be points where it's going down, and then people really panic and it overshoots. That's kind of a key thought, right? It overshoots. The rubber band becomes stretched too far and then it snaps back. So even in the context of this declining market, there will be moments and points when it rallies significantly. And you also will have points where people are trapped on one side of the trend, where if you can imagine, conceptually, what moves a market? It's people changing their opinion. That's kind of a key thought. It's a fundamental thought that I did not realize for a long time. A market's not going to go up because everybody in the world is bullish. That's actually the point you become concerned. What makes the market going up? What makes the market go up is people buying. What makes people buy is people changing their opinion from either they were bearish, they thought the market was going to go down, or they were neutral, they didn't know, but then they become bullish and they want to buy. So it's that act of people buying a market. And I say people, it could be institutions, but it's people switching camps, basically. It's people switching sides that moves a market. So when you have everybody in consensus, if you imagine a market going up and everybody in the world who could possibly buy that market is bullish, there's literally nobody left to buy. Now, it's obviously never quite so black and white, but there are probably times in some markets that it's pretty close to that black and white. And when there's nobody left to buy, only bad things can happen to that market. Another thing that we need to think about this, kind of another layer of complexity, brings a little closer to the real world. Be aware that people might not buy because they think it's really going up. For instance, if I am short a market, and this is my experience many times, for instance, in the bear markets, 2008, 2009, there would be many times that we would come in the morning and people would be panicking. And during that time period, there were a lot of people who were saying a lot of negative things about short selling. And there were talks about the government. Some markets actually did restrict short selling, despite the preponderance of evidence that shows that that's just a political move that actually does nothing to stabilize markets. That claim also was carried out by the short sale restrictions. We saw it did nothing to stabilize markets. There were many, many points where we would come into the morning and something would be down, people would be really panicking. And what am I doing? I'm buying. I'm a short seller. I shorted a while ago, and I'm buying when everybody else panics. I'm buying to cover my shorts. So from an active trader's perspective, and markets have different mixes of long-term and active traders, but an active trader selling is not necessarily a bearish bet. An active trader buying is not necessarily a bullish bet. It could simply be that I bought a market and it reached my profit target, so I'm selling. That doesn't mean I think it's going down. And by the way, like all of these services that claim to show you options flows that will give you directional, they certainly can show you option flows. Anybody can analyze that data, but whether or not it has a directional implication for the market is another question. So you just have to, we got a little bit far afield with that, but you just have to realize that it's people changing opinions and the act of buying and selling that moves a market. That also was a revelation, that it's only what people do. You can say, you can think, you can feel whatever you want about a market, but market prices move only because people buy and sell, or maybe because they spoof orders in, if you want to be cynical. So we're not talking about this sort of classical, quote, trend following, end quote, as an approach. If we're talking about trading with the trend, then we can think about trading with an existing trend. And techniques would be, there are various chart patterns for this. Rectangles, pivots, pullbacks. And I would even say, I don't use those patterns. I just look for pauses and trends. You could even do things, I could imagine you could probably structure some kind of system with multiple moving averages if you wanted, where maybe you had a longer term moving average that gave you the trend and you were looking to trade some type of turn with a shorter term moving average. You could perhaps do something like, I remember we're looking at pauses in an existing trend, where maybe you have a long-term trend defined with an average, and then you have some indicator that will show you when the trend is maybe maybe you look for a pullback in the trend, and you could use RSI in different ways. I almost kind of stepped into several complications there, but just understand that you could have an indicator that would show you where the trend has taken a short pause. And you could use indicators or chart patterns. You also, as I mentioned, breakouts earlier in the podcast. This would be an ideal time, whether you're using some type of chart pattern that shows a breakout over a multi-bar. You could do something like using an inside bar and using a breakout of that, or a breakout of the outside bar to that inside bar. So a lot of different ways to structure this. But again, what you're trying to accomplish is you found something that's trending and you're looking to position with that trend as long as the trend shows no sign of ending. So if we have a sign of ending, though, this puts us with trading with maybe a new trend. Existing trend, new trend. What would be some signs of a trend ending? Well, people would use momentum divergence. You could use here, there are chart patterns, a classic head and shoulders pattern, which is a pattern that I don't find any utility whatsoever in, which, I realize puts me, it's funny, every now and then I get put in the category of classical chartist, but I don't use classical chart patterns, so I don't quite know how that happens. Double tops, double bottoms, sort of ironically perhaps the way that I started trading, which I've told the story many times elsewhere. Though the program was largely a scam, it was based on trading what this guy called 1, 2, 3 bottoms and 1, 2, 3 tops. And what this is, if you understand how to find it on the chart, so the 1 is the low point, and then the 2 is the swing from the bounce, and then the 3 either makes a lower low or not quite a lower low. So what you're looking for is to identify the extreme of a trend and take a reversal. Now, the advantage of this kind of trading is if you do this a lot, you will have a lot of losers, and you'll have a lot of small losers, because it's relatively easy to define when the trend is going to continue. And then when you have winners, you will have big winners. So these are the types of techniques that will allow you to pick off tops and bottoms in markets and then potentially hold the positions for years. It's kind of funny if you think about it, right? You are at one point a counter trend trader, and then you become a with trend trader. Nobody really hopes to be a counter trend trader, by the way. Counter trend trader loses. What you're really hoping for is, like in this case, a market's going down, down, down. You think you find a bottom, and if you find a bottom, you're going to buy it. Well, you're buying a market that was declining, might even still be declining, might have made some kind of bottom. But what you're really betting on, hoping for, is that a new uptrend will emerge, a new trend in the direction of your trade. I don't really think there's anybody who buys a market hoping it will continue to go down. So let's switch our attention to thinking a little bit about those legitimate counter trend trades. And with that in mind, if this is a little bit too much complication, I apologize, but what you're really hoping for is that when you pick off these extended points and trends, that you have a counter trend. So a trend that goes against the bigger trend, perhaps on a lower time frame. For instance, let's say that I have a stock market, like the market we're looking at in the US right now, that just goes up, 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 up. And if I'm looking to trade that from a counter trend perspective, I'm looking to short. Now, what happens if I short a market that's going up, up, up? I get run over. It's very painful. I lose all my money. And end of story. Well, that's not what we want to have happen, right? So what we're hoping for is if you see this market that's going up, 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 it doesn't go in a straight line. Now, we keep coming back to that, don't we? It doesn't go in a straight line. So what we would hope to do is pick off some of those points where maybe people get a little bit euphoric, where maybe almost everyone in the world who wants to buy stocks has bought stocks, where almost everybody is in the bullish camp. And there are different ways that we might define that. But what we're really hoping for is that we will short the market and then a strong downtrend will develop for at least a few days, realistically. You're not hoping that if your head is screwed on right and you're an active counter-trend trader, you're not hoping that you're going to short the Dow Jones Industrial Average Monday morning when the market opens and it's going to go to zero. That's not what you're hoping happens. What you're hoping is that you find the spot to short it and it goes down for a few days, maybe a few weeks, and you make a little bit of money and run away. So what you're really hoping for is, and then it may very well continue to go up. So you have this existing uptrend on the daily time frame, but what you're looking for is some type of trigger that there's going to be a downtrend that we might see maybe on the hourly chart or some other intraday chart. So it's a trend nested within the bigger trend. It's not a bet that this bigger trend will reverse. Examples of patterns, well, climax patterns are one. A climax pattern you can see when the market goes outside of certain kinds of bands. I like to use Keltner channels. A lot of people use Bollinger Bands. I would argue it doesn't really matter what you use as long as you have some way to say, here's how the market normally fluctuates and bounces around. Now we're outside of that. So now this is an extreme. You can use indicators. You can use RSI is quite common for this. You could do something with different kinds of divergence. There are a number of chart patterns, a number of candlestick patterns that are designed to find this. What you're really looking for here, people talk about the concept of overbought, oversold, but you're just looking for those overshoots. And I'll kind of give you a couple thoughts on those. So with these overshoots, how you define them does matter. And most people probably find that using some indicator, this is where indicators might be more useful than in many other applications. Using indicators can be very helpful, but look at the second time a market goes oversold. So you'll have your oversold reading. Look at what happens if you have another oversold reading within a certain time window. Many times those tend to be the better readings. So that actually is I don't want to get too excited, but I'll just tell you, that's a pretty big nugget right there. That's a piece of gold that you can run away from this podcast and start testing. Look at not the first overbought or oversold reading, but look at the second one. And you might be surprised what you could do with that. These require, these with trend or counter trend trades require different psychology and trade management, but we'll leave that for a future podcast and just kind of wrap up here. I'd also like you to take a look at my websites. Go to marketlifetrading.com. There is a gigantic and completely free trading course there. I also have a number of services for active traders. I share some of the best screening tools that I have ever seen, the tools that I've used personally for a long, long time. And you get to see every day. I do a video talking about markets, everything from stocks to currencies to some of the basic commodities that people trade. And really what we're looking for here are both pointing out the overarching tendencies in the markets, where there might be profitable trades, but more than anything, really helping you develop the skills to develop your own trading program and to move toward being a consistently profitable trader. So that's marketlifetrading.com. Go check that out. And one last thing, wherever you found the podcast, subscribe, leave a review, tell everybody you know about it. I certainly will appreciate that. And I'll see you back soon for another episode. Thank you very much.
It's never hard.